Hey guys, what's up? This is Akash again. So I thought in this video I'll just discuss a few commonly used jargons in trading. Jargons as in trading lingo, so whatever the terms that traders use while they're actually taking a particular trade. To start off with, all these financial institutions actually make the finance world seem like a really complicated and very complex process. But to be honest, it's not. They just use different terms so that the normal people may not understand it. For example, in the news, you may see some days that they might say it's a bullish market or a bearish market today, etc. etc. These terms are just used to indicate what the current scenario of the market is. For example, if they say it's a bullish market, it just means that the prices are moving up. Similarly, if they say it's a bearish market, it means that the prices are moving down. As I mentioned in my previous videos, that the stock market is a fight between the buyers and the sellers, right? The bulls are basically the buyers in the market. Bull like the animal. The bulls push the price up. And similarly, the bears push the price down. Bears as in the sellers. When there's a selling pressure, the prices go down. Similarly, when there's a buying pressure, prices go up. The buyers are called bulls and the sellers are called bears. So a stock market is nothing but a fight between the bull and the bear. So the next time you hear bull market or bullish candle, all they're saying is that the buyers are in control and the prices are moving up. Similarly, the next time you hear bearish market, it just means that the sellers are in control and the prices are moving down. Another couple of terms that traders usually use is long and short. So when you're going for a normal trade where you buy into a position and they're expecting the prices to go up, that trades are actually called long, L-O-N-G, long. So similarly, if you have bought a Nifty index with the expectation that the index is going to go higher, then you would say that I am having a long position on Nifty. So if you are long on a particular stock, it just means that you have a bullish view towards the market. Bullish view in the sense, the buyer's point of view. The exact opposite to long position is the short position. So if you expect the prices are going down, or if you are expecting a bearish movement in the market, at that point of time, you short your stocks. I have discussed about short sell in the previous videos, you can refer to it. Short selling basically means that if you expect the prices to go down, you can still make money on that by shorting your stocks, and you can capture how much ever the prices fell. That's how much you're going to profit from that particular trade. A few other terms which are very common in the markets and very useful is, one is trend. Okay, trend as in trend depicts what the overall trend of the market is. Trend in the sense, if the market prices are going up, you will call it an uptrend. Similarly, if the market prices are going down, you call it a downtrend. Now, if the market is going sideways, or if it's range bound, the prices are going up and down but in a sideways range, but very small price movements, then it's called a side trend. So these are the main three types of trends, which is uptrend, downtrend, and side trend. So the word trend usually refers to the general market direction and its associated strength. For example, if the market is declining fast, then it is said to be bearish or a downtrend. Similarly, if the market is gaining pretty rapidly, then it's called a bullish point of view or an uptrend. If the market is trading flat with no significant movement and it's just going sideways, then it's called a side trend. It's very important for you to understand a trend at one point of time, because as a trader, you should always follow the trend. It's a very common saying that the trend is your friend. So all you have to do is just follow the current trend. If it's going in an uptrend, then try to take your trades based on uptrending itself. So you have a higher chance of getting profitable trades if you're actually just following the trend. So it's an advice to all the beginners out there to never trade against the trend. Okay, always follow the market. If the trend direction of the market at that point of time is actually bullish, go for bullish positions. Similarly, if it's going to be bearish, saying that it's going to go down, then go for short opportunities. There are other terms like 52 weeks high and 52 weeks low. 52 weeks high just represents the highest price at which the stock has traded on for that 52 weeks of time. 52 weeks is almost 1 year, so we can say 1 year of time. Similarly, 52 weeks low would represent the lowest price at which a stock has traded on that year. So the 52 weeks high and 52 weeks low gives you a sense of the range in which a particular stock has traded in that particular year. So many people believe that if a stock is trading at its 52 weeks high, then it's likely to have a bullish trend in the near future. Similarly, if a stock is trading at the 52 weeks low, it's likely to have a bearish trend in the near future. So traders can take pre-open market trades and different types of trade setups depending upon if a stock is actually near its 52 weeks high or 52 weeks low. Similar to 52 weeks high and 52 weeks low, there is also something called all-time high and all-time low. As the name suggests, all-time high and all-time low just represents the highest price at which a stock has traded on from the moment it has been listed on the stock exchange. So the highest price at which it has been traded is called the all-time high, and the lowest price at which it has traded on is called the all-time low. Then there is square off. Square off is a term that is used to indicate that you want to close your position on a particular stock. Close your position in the sense, if you were long on a particular trade, like you have bought a particular trade, when you click the square off button, it means that you're selling that stock just to exit your position. So similarly, if you are shorting a stock, that is, shorting means you're just selling the stock. So if you want to square off, it means that you're buying back that position. So your trade is closed over there. So in other words, square off is just to exit your trades. One more term that comes up is the OHLC. So it represents open, high, low, and close. So on a particular day, the OHLC will show you what is the opening price at which the stock had started it trading, and high will show you the highest price at which the stock had traded on that day. The low will show you the lowest price at which the stock had traded on that day, and the C is for close, which is the closing price for that particular stock on that day. OHLC data will show you the open, high, low, and close. Then there's also volume. Volume represents the total transactions that's being done on a particular stock on a particular day. The more volume there are, it represents that it's more active stock, meaning there are more traders trading on it, or there are more transactions happening on a particular stock. Now, volume is a very important concept in technical analysis. When you're trading, volume plays a major role in identifying which trades to take. The last one I would want to talk to you about is the different segments within a particular exchange. For example, there are mainly 4 major segments within a particular exchange, which is equity, futures and options, commodity, and currency. Equity is the normal share market. When you say you want to buy a particular Reliance share or something, it's actually you're buying into the equity market. So the normal buying and selling of company shares happens in the equity market. Then there is currency. Currency is basically you're trading on currency pairs. Currency pair in the sense USD INR pair. Then there is USD Euro pair, USD Japanese pair. So all currencies between countries can be traded on. Even that value keeps going up and down. So you can actually trade on that as well. This is not really legal in India because the only legal pairs that's allowed is the INR pair. So USD INR, Euro INR, all of these popular pairs only are available in India. But this is a very popular form of trading and it's called forex trading, and it's available all throughout the world. Then there is futures and options. That is the NFO segment. Futures and options is basically a derivative market. Derivative market in the sense its price is derived from an underlying asset. An underlying asset being the indexes and the stocks. When a stock moves, even the future and options prices also moves according to how the stock behaved. In other words, futures and option prices are actually based on how the prices are moving in the stocks or the indexes. Now, this particular market segment will give you high returns, but the problem is it's equally risky. So if you're a beginner and you're trying to trade, do not ever get into futures and options segment. NFO segment is only for people who have enough experience in the markets and are willing to take the extra risk. So if you're a beginner, this is not the segment for you to start with. It's the last one. First, you master with equity. Equity is the one in which there is low risk comparatively. You make your way, you practice, and you get better and better, and then you step into futures and options. There is also the commodity segment in which you'll be trading commodities. Commodities like gold, aluminium, silver, copper, zinc. All of these commodities can be traded on, like crude oil, right? So even these commodities have charts in which we can analyze and we can trade on. So even this is actually a riskier market compared to the equity market. So what I would recommend is, if you're starting out trading, you start with the equity market, and then once you're confident with your trade setups, then you move into the other segments, because the other segments will give you higher profits, but the problem is there is also a risk involved into it. So once you master risk management and once you learn how to trade for real, then you can go into higher profits. So it's a slow process. You have to take your time, keep practicing, get better and better, focus on your risk management, focus on your trade setups, and once you're really good, you can venture into all the other segments and keep getting a better hold of it, and your profits will also increase accordingly. So I hope you guys found this video pretty informative, and I hope the basic jargons in the stock market is cleared out for you guys. Thank you for watching, and subscribe to our channel if you found this content worthwhile. We'll be releasing a lot more content for trading based so that you guys can learn on your own pace. Have a good learning. Peace out.